Okay, so now we have to do question number 3, which says calculate the tax liability for the Pillay Family Trust for the 2023 year assessment. Show all calculations, provide explanations for amounts which are not subject to tax or where no consequences arise. Okay, tax liability, not just taxable income. It's important to see that. Okay, so when we're looking at the tax, or the trust, not the tax, the trust, remember we have to look at these amounts which were undistributed. So that's the only amounts they can get taxed on. So the first thing is this undistributed income, the local dividends. I'm just reminding you the trust deed said that 50% of that amount must go to Sophia, and then the other 50% doesn't go to anybody. But Carl was already taxed on that. So I'm just going to make the comment here, undistributed income. So first one is the local dividends. Section 7.5 applied, taxed in donor's hands. There was also the part to Sophia, but remember that is not the undistributed income for the trust. It is undistributed for the trust, but I'm only talking about the amounts which the trust could potentially be subject to. Okay, next one is the net rental income, which is null, so it's nothing to do. Then we've got the foreign dividends, 245,000. This is the net amount. 245,000. Who does that belong to? The foreign dividends. Sophia has a vested right to 20% of the foreign dividends. Jacob to 30%, and it doesn't. There's no one with a vested right to it, to the undistributed income. So that 245. There's no donor, so the trust can be taxed on it. It's under section 25B1. 245, like that. Oh, I'm wrong. The 245, remember guys, is the net amount. So to calculate the amount before tax, we say times 100 over 88. Okay, that gives us 278,409. Section 10B3 applies. This is a trust, so it's 278,409. A trust is 25 over 45 of it is exempt. Okay, and remember there was foreign tax on that, so we're going to have to do it for section 6 quat. Okay, next up is this local interest from local dividends. They say Sophia's vested right to 20% of the amount. Sophia's vested right will increase to 25%. No person has a vested right to the income that is not distributed. Right, so that is the local interest. This first one over here, remember it was taxed in Carl's hands. So I'm just going to make the comment here. And then local interest from foreign dividends. So that's 50,600. That gets included there. Sorry, 50,600 like that. Section 10(1)(I), the interest exemption, does it apply? It's not a natural person. Okay, then what else happened, guys? Those flats were sold. Okay, now let's talk about the sale of the flats. This is important here. When you sell flats, paragraph 80 says the person who has a vested right to it, Sophia and Jacob, must be taxed on it, but only if they are residents. So Sophia's share will be taxed in Sophia's hands, or in the donor's hands if there was a donor. Remember, it goes to Sophia, and then you say, is she a minor? Yes, her father donated it, therefore his father gets taxed. Remember, there's the same type of Section 7 rules, but also in the 8 schedule. Just reminding you, not applicable here, just reminding you. Okay, paragraph 80. And then the part of Jacob will be taxed in the hands of the trust. So, sale of flats. So the proceeds, it was 8.1 million. There were 2 of them. I know you might feel like, let's just do it for the one, because it's only one flat, but that's, I suppose it makes sense. But you could also have this different type of argument and just say that it is half of each flat, but I want you to just do the full process like we're doing here. 16,200, this is 7,800. So, distributed to Sophia, paragraph 82, taxed in her hands. Jacob, non-resident, thus paragraph 80 says taxed in trust. You could just say non-resident, just therefore taxed in trust. So 7.8 times 50% is 3.9 million. Okay, there was nothing else for us in the trust at this point. So we add up everything in the CGT column, which is 3.9 million. Is there an annual exclusion? No, because it's a trust. Okay, so just reminding you. This is the aggregate capital gain. Then we have our inclusion rate. Inclusion rate trust 80%, remember. Uses taxable capital gain. $3,120, and that goes into my column. Right, I add up everything. I'm just using the amount per the solution here. Obviously, you'll add up yours. That gives us taxable income. Right, the tax, the trust, so tax at 45%. It's 1482452. Important there, write down the percentage. Now, these foreign dividends over here includes tax, right? So, first thing I want you to see is if you add those two up, the sum of that, you calculate the taxable amount. 278,409 minus 154,672. Okay, that gives you a sum of 123737. Now that amount ends up in your taxable income, so 45% of it gets taxed. So this is basically what it means. It means section 6 quat is the lower of South African tax. So you could now say 123,737 times 45%. That's the easiest one because it's a trust. Right? It works out, and you could say it's 55,682. It works like for companies also because the tax rate is a standard. The better way of doing it is to say it's 123,737 divided by the taxable income, 3294,337, and then to multiply that by the tax. Now again, that gives you the same amount. But remember, if this was a natural person, they have a tax table. You can't just use the tax rate which they are in, because the tax rate will, remember, even when you're in the highest tax bracket, all the lower tax brackets are included in there. So it's not the rate that you see in the tax table is not the rate at which you pay taxes. You pay it at less than that. It's the effective rate. So this is the way to do it correctly. So for all taxpayers, you have a standard approach. But if you understand the concept of what the tax will be, if you understand that these two amounts in this case will be the same, then use that one. Or we can use the foreign tax. Now what was the foreign tax? The foreign tax they tell you the trust got 38,830. That means it would have been this 490, right? So on that amount, there was 4,660 tax, and the rate is 1396. So the foreign tax is 4660 times 13.96. But then the trust is only taxed on how much? 245. 245 out of the 490. So 245 out of 490. You have to they're only getting taxed on a portion, so you can only get the benefit of a portion. Now, I know what a lot of you will say to me, but you'll say, but isn't that strange? Because isn't the taxable amount that they're on 123737 instead of 245? Just to remind you, 245 is the amount that we included in there. Right? Obviously before tax. You could also use these high amounts. Shouldn't you just be taxed on a net amount? And the answer is no. The foreign tax, you don't apportion for the taxable part. That is what's one of the things that section 6 quad tells us. So you use the full amount like I've done here. Right, and that gives you 32527. So that's how much foreign tax you treated as you pay. So Africa would be 5562. So you can only get the lower of the two as a rebate under section 6 quad, because that's the only amount you're paying tax on twice. Now again guys, a lot of you might now feel panicked if you don't know section 6 quad. This is 2 marks, 1 or 2 marks in the question, so I wouldn't panic about it too much.